Good day, everyone, and thank you so much for joining our webinar this month. I'm Angelica Kemene, Head of Market Climate and ESG Strategy at Optima Shipping Services, and today is our January 2026 monthly pulse. So we will stay deliberately focused on two markets, that's the oil tankers and dry bulk carriers. And the goal is not to over forecast, it's just to answer three practical questions. What changed in the past few weeks? Why it matters for Q1 and 2026 exposure, and where we would stay selective. Because this is not actually a market that rewards a wide sectors. Um, let me start with the headlines. So for tankers, momentum returned in mid-January and average earnings jumped week on week, led by VLCC and Suezmax, and the tone stayed actually constructive. Products also firmed with strength led by LR2 and MR, and in some cases even in LR1s. For dry bulk, it's mixed and seasonal, and exactly what someone would expect for early Q1. Capesize eased as Pacific activity cooled late week, while Panamax rebounded on South America grain flows. The forward markets point to firmer Q1 averages than early January spot. For the assets, prices remain firm, and that's important. And when asset prices don't give back easily, the market is telling you something. Capital is still comfortable underwriting this cycle, but only where the fundamentals justified it. That's why our position or stance into 2026 is selective support. Now let's quantify the tanker move first. This chart is the cleanest way to describe what happened. What happened. So the market repriced quickly. Average weighted oil tanker earnings moved from around $38,000 per day on the 2nd of January to $42,400 per day on the 9th of January, and then up to about $54,800 per day by mid-January. Shipping markets don't reprice actually because everyone suddenly feels optimistic. They reprice when the system discover it has less available tonnage than it assumed, and that gap can appear overnight when geopolitics and loading programs align. On this slide, the what changed is clear. Geopolitical uncertainty plus strong loading activity tightened fundamentals, pushing VLCC and Suezmax earnings above the $100,000 per day mark during the week. So what exactly tightened and where? Mid-January market color is telling that the VLCC had a strong week with tonnage tightening in the east as January stems were closed. The Suezmax rate strengthened across West Africa, US Gulf, and Guyana, and owners clearly had the upper hand. Aframaxes, they were firm in the North Sea and the Mediterranean, with strong gains on Black Sea linked trades. The selected route markers capture this intensity. So West Africa to UK continent, the Suezmax is with world scale 175. The Black Sea for a Suezmax is world scale 260. The cross UK continent for an Aframax is at world scale 160. And the Black Sea Med Aframax is at world scale 250. Now, the why it matters for 2026 line is not that we will sit at peak levels forever. It's actually that volatility plus tight positioning rewards scale exposure in VLCC and Suezmax. Because actually, when the market tightens, the repricing is non-linear, and Aframax remains this tactical tool around regional dislocations. In crude, the cycle isn't only about demand growth; it's about how often the system gets surprised by effective supply. And 2026 still looks like a year where surprises remain possible. Um, on products, the message is firm but nuanced. West of Suez, MR momentum eased midweek, but prompt lists stayed tight and weather delays supported rates. East of Suez, LR1 remained strong, and LR2 rates rose materially on tighter tonnage and stronger actually crude earnings. The point I would underline here is the linkage. When crude earnings accelerate, it often it often it often pulls behavior across the barrel complex, so positioning, triangulation, and optionality. Products don't live in isolation. And for 2026 exposure, this matters because products are not just a refining margin story, they are also a trade pattern story. And trade patterns have been structurally less efficient than the pre-2022 world. Let's now move to the dry bulk, where the story is more seasonal and more selective. Dry bulk spot is behaving exactly like an early year market should. Cape size softened as Pacific activity cooled late week and seasonality persisted. Meanwhile, Panamax rebounded on South American grain cargoes, and importantly, the forward curve still implies firmer Q1 averages versus early January spot. The Cape Size weekly earnings chart makes this direction clear. Roughly 22,000.6 K dollars per day at the start of January, easing to about $19,000, $800 per day on the end on the week ending 9 January, and around 17,000 $800 per day by mid-January. Um, so our bottom line here is exactly what you see in the slide. Selective in bulk exposure. We prefer Panamax, Kamsarmax, where cargo flows are supportive, while Cape size remains more sentiment-driven near term. In bulk, the question is rarely actually, is demand good? The better question is demand good enough to absorb supply without needing sentiment? In Cape, sentiment does a lot of the heavy lifting, which is why we stay disciplined. This slide is key because it separates noise from signal in a way. Spot can be seasonal. Period reflects what charterers are willing to underwrite. And here, time charter improvements suggest charterers are locking in cover, which is supportive for earnings stability in or during the first half of 2026. So even while spot digests seasonality, the period market is quietly saying um, it is paying for continuity. Now, let's connect both markets to capital allocation and use the asset lens. The slide you see now is the bridge between market talk and investment reality. On the left, we have the 5-year asset indication that show firm pricing across the core segments. You see VLCCs at 100 million 24 Uh, dollars, Suezmax around 84 million, LR2 75 million, the MRs at 44 million, and the bulks for Kamsarmax, a 5-year-old Kamsarmax is around 33 million, an Ultramax around 32 million, and a Handysize around 27 million. So the takeaway isn't assets are cheap. Obviously, they're not. The takeaway is the cost of wasting is visible. When prices remain firm, the market is telling us that optionality has value. So for 2026, firm asset pricing supports capital allocation to segments with tightening supply, strong trade flows, and clear dislocation catalysts, particularly within the VLCC, Suezmax, Aframax, and Panamax, Kamsarmax segments. In other words, in this place of the cycle, you don't get paid just for being long shipping. You get paid for being long the parts of shipping where inefficiency keeps returning. So where do we stand? For tankers, we stay constructive, tight positioning. We have tight positioning in VLCC Suezmax that can reprice quickly on geopolitics and loading programs. Aframax remains tactical for regional dislocations. Med, Black Sea, North Sea, and the products, especially LR2 and MR, benefit from crude spillover and shifting trade patterns. For the dry bulk market, we will be selective and disciplined. Panamax, Kamsarmax are supported by grains and diversified commodity flows. Capesize remains the highest beta segment, with preferred exposure via risk management structures, and time charter signals suggest improving stability into Q1. So to close, strong early year S&P activity provides price discovery, and a 5-year old VLCC values around, as we saw previously, at 100 million 24 hundred dollars, and this highlights the cost of waiting for entry. So overall, in 2026, the winners won't be the ones who predicted the average rates perfectly. It looks like it will be the ones who pick the segments where the market keeps rediscovering tightness. So I will stop here, and thank you very much for joining. Bye.